Luan Limited purchases a 10% 1,000 Rand debenture that is nominal value and nominal rate that represents the cash flow that will take place between the issuer and the investor. Purchases that on 1 January 2011. It is issued by Mandla Limited, a company listed on the JSE Limited. The debenture was purchased at 95. What does that mean? It means at 95% of the nominal value. So not 100% of the nominal value, lower than that. That means it is issued at a discount. This debenture matures in 2 equal annual installments on 31 December. Now, a debenture can mature once off or it can mature in installments. In this case, it matures in 2 equal annual installments on 31 December, starting on 31 December 2012. It matures at 110. What does that mean? It matures at 110% of nominal value. Not only 100%, more than that. So it matures at a premium. The interest on this debenture is payable on 31 December. So we know what the interest amount is for the entire year, nominal value times nominal rate. That doesn't mean the interest should only be paid once a year. It can be monthly interest, but in this case, interest is payable on 31 December. We already spoke about the market-related interest rate. What else did they tell us? Transaction costs of 75 Rand were paid in cash in respect of the purchase of this debenture by Luan Limited. So what do these transaction costs represent? Well, Luan Limited could have used a broker that did this debenture transaction on the JSE Limited. And if a broker did this transaction, they will charge a fee. And Luan Limited will have to pay that fee. And Luan Limited paid a transaction cost of 75 Rand. Luan Limited's reporting date is 31 December. Now the next sentence. The objective of Luan Limited's business model is to hold the debenture in order to collect contractual cash flows. The contractual terms of the debenture give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. Why is this information given to you? It is given to you so that you can decide which category of financial instrument you are dealing with. To know that, you need to know your theory of the different categories. And if you look at the category at amortized cost, it says your objective and your business model should be to hold the debenture the whole time until its maturity date, not to sell the debenture, in order to collect the contractual cash flows that consist of the interest, that is your proceeds on your investment, the interest, as well as the capital or the principal payment, that maturity payment. So this sentence helps you to categorize this investment into the right category financial asset. And in this case, because of this information, it can fall in the category at amortized cost. We continue and they say the asset was at no stage credit impaired. Ignore expected credit losses. We do not do impairment of financial assets on second year level, so this will always be true. It was at no stage credit impaired and you can ignore expected credit losses. Then they go over and they actually speak about the issuer, Mandla Limited. Mandla Limited did not designate the debenture as measured at fair value through profit or loss. The default category for Mandla Limited, who is the issuer of the debenture, in whose books it will be a financial liability because they have the obligation to pay cash at a future date. The default category for financial liabilities is at amortized cost. But Mandla Limited could have chosen to designate the debenture out of the default category into the category at fair value through profit or loss. So what we are telling you is Mandla Limited did not designate the debenture out of the category at amortized cost.